Investment experts always advise us to grow our money through different asset classes instead of putting all our savings in just a single asset. Here is where futures trading could be a trading opportunity. But what exactly is a futures contract? A futures contract is a transaction that is done now to gain from the future value of an asset at a future date. When sold at a higher price in future, you will make a profit. Some examples of futures contracts are palm oil futures, index futures, gold futures, and others. The advantage of futures contracts is that you can participate anytime, regardless whether the market is going up or down. The futures contracts in Malaysia are regulated and are exchange-traded products on Bursa Malaysia Derivatives Berhad, BMD. There are three categories of products on Bursa Malaysia Derivatives, BMD: commodity derivatives, equity derivatives, and financial derivatives. So, what is the basic strategy in futures trading? Very simple. You buy futures when you expect the price to go up and sell it when you expect the price to drop. You can also sell futures when price is falling and buy back at a lower price to close the trade. This is how futures can help you to profit in a declining market. The return on investment, ROI, performance of your trades, or in other words, how much you gain from it, will depend on your knowledge to analyze the market, when to cut your losses, and how you set up your risk management and trading plan. For example, you expect the crude palm oil CPO price to increase as the current dry weather will affect CPO production. So you buy one crude palm oil futures FCPO contract at 2,700 ringgit. You deposit 4,500 ringgit as the initial margin. When the FCPO contract prices increases to 2,750 ringgit, you sell at 2,750 ringgit and make a 1,250 ringgit gross profit. After deducting transaction fees of 30 ringgit, your net profit is 1,220 ringgit. Therefore, your return on investment, ROI, on your initial 4,500 ringgit deposit is 27%. On the other hand, you expect the CPO price to fall as ringgit strengthens, so you sell one FCPO contract at 2,700 ringgit. You deposit 4,500 ringgit as the initial margin. However, FCPO price rebounded and you are forced to cut loss at 2,750 ringgit, so you suffer a 1,250 ringgit gross loss. After deducting transaction fees of 30 ringgit, your net loss is 1,280 ringgit. Your return on investment, ROI, on your initial 4,500 ringgit deposit is minus 28%. Again, the key point to remember is buy when you expect price to move higher, sell when you expect price to drop. To learn more and practice using a virtual trading platform, please log on to www.bursamarketplace.com. Even with the help of a licensed professional, you must understand the basic workings of a futures products, and please refer to licensed brokers only. Please log on to www.bursamalaysia.com.my for the list of licensed brokers. If you are unsure, please seek professional advice from licensed professionals approved by Securities Commission. Please log on to www.sc.com.my for the list of licensed personnel. Remember not to seek help from unlicensed parties to avoid being scammed.